Good morning. I'm Giancarlo Grasso, Director of Strategy and Business Planning at AMCHAM Korea. Thank you for joining us today for our first Tax Committee meeting of the year. The AMCHAM Tax Committee serves as a forum to identify, discuss, and address key tax issues that impact AMCHAM members, as well as the broader business community in Korea. We hope you find this presentation especially beneficial. Shim from Lee & Co. is one of our co-chairs of the Taxation Committee, and he will be introducing the speakers and moderating the committee session today. AMCHAM strives to foster strong relations between the U.S. and South Korea. We want to thank our speakers and the Tax Committee for providing this valuable content to us today. If you have any questions during the webinar, please use the Q&A function at the bottom of your screen. Without further ado, I'd like to hand it over to Jay.
Good morning, everyone. Thanks, Giancarlo. I appreciate your introductory comments. My name is Jay Shim, and together with Henry An and Sean Kang, we are the co-chairs for AMCHAM Taxation Committee, to be sure. I have a very interesting topics today. And what I want to do is very briefly introduce my speakers, and then we can move on. The first topic is on the 2022 tax revisions and amendments. I think you'll find this very interesting, and it will be presented by Tom Kwon. Tom Kwon is a newly appointed international tax practice leader at Lee & Co. And he's an international tax specialist and a partner of our tax practice group. Next to him, or together with Tom, we have another speaker who is a tax partner at Lee & Co. He's a newly appointed partner. His name is Minhoo Kim, who is also a transfer pricing specialist. And without further ado, let me turn the mic and video over to them. Thank you.
Thank you for the kind introduction, Jay. It is a pleasure to be with all of you today, and we are grateful for the opportunity to present in front of such a distinguished and important audience at AMCHAM. Now, without further ado, we will start topic 1, summary of key tax law amendments for 2022. Steve Kim and I will discuss some of the tax law and related presidential decree amendments, as well as changes to the transfer pricing related rules and regulations that may impact foreign investors. In July of last year, the Ministry of Economy and Finance, or MOEF, announced the government's tax law change proposals for 2022. According to the MOEF, the tax law amendments were intended to encourage economic recovery from COVID-19, increase fiscal support, and drive the growth of industry sectors that will boom in the post-COVID era, reduce the economic inequality that has worsened, and improve anti-avoidance measures. These proposals have generally been enacted into law without significant changes as of January 2022. Please kindly note that, separate from the tax law changes, the related presidential decree amendments, or PD amendments, were just recently enacted as of February 15. PD amendments are statutory changes enacted by the administrative authority and are intended to serve as regulations to clarify or supplement the tax law, which are enacted by the National Assembly. Although not at the same level of authority as the tax law itself, it is generally regarded as persuasive and can be viewed as comparable to the Treasury regulations in the US. The first tax law amendment I would like to discuss is the extension of the concessionary flat tax rate for foreign nationals working in Korea. Generally, foreigners working in Korea are subject to the regular individual income tax rates, income tax at the standard tax rates, just like Korean citizens. The rates are graduated from 6.6% up to 49.5%. However, there is a special elective flat tax regime for foreigners who are employed in Korea the first 5 years of their employment. In addition, under a separate regime, certain qualified engineers, researchers, and specialists can claim a special tax exemption for 50% to 70% of their Korean earned income for the first 5 years of employment. The tax law amendments extend both of these elections up to December 31, 2023. In other words, a foreign national who starts working in Korea can make this election up to the end of 2023. Next, I would like to discuss new reporting requirements for real property held overseas. Many foreigners are aware that they may be required to report foreign financial account information, such as foreign bank and brokerage account information, if they are regarded as Korean tax residents. The tax law amendments have expanded the scope of the reporting disclosure requirements to now also include foreign real estate. Previously, only Korean residents who operated and received rental income from their overseas real property holdings were required to report such assets. However, going forward, Korean residents, including foreign nationals, will be required to report all their overseas real estate over a certain value, even if not used for business purpose. Failure to report will result in an administrative penalty equivalent to 10% of the property acquisition price, which is a significant amount. The next tax law amendment I would like to discuss is R&D tax credits. Like many countries, Korea provides for tax credits for certain costs, such as R&D costs, investment in facilities, and for creation of new jobs. A tax credit, is the amount that a taxpayer is permitted to subtract from its tax payable that the taxpayer owes to the NTS. Therefore, tax credits are generally viewed as much more favorable than tax deductions. Historically, Korea provided R&D tax credits for qualifying costs based on a two-tier structure. Under this structure, higher tax credits applied to new growth in core technology, while lower tax credits applied to R&D costs associated with just ordinary industries. The tax law amendments changed this to a three-tier system by adding a third industrial sector called National Strategic Technology. The tax law amendments provide super tax credits for R&D costs, investment in facilities, and human resource costs related to such national strategic technology industries. These include semiconductors, car batteries, and vaccine development and production. The tax law amendments also provide enhanced R&D tax credits for new growth in core technology industries, such as carbon neutral industry and biotech. But these credits are less than for the national strategic technology. This is expected to apply to qualified R&D costs incurred up to December 31, 2024. The next tax law amendment relates to beneficial ownership requirements for foreign funds. Generally, under Korean domestic tax law, a foreign fund called an overseas investment vehicle, or OIV, should be disregarded and looked through for tax purposes, and the investors of the OIV would be viewed as the beneficial owners. However, in certain prescribed cases, the OIV itself can be viewed as the beneficial owner. The 2022 tax law amendments prescribe an ordering rule and clarify the conditions when the OIV, rather than the investors, can be viewed as the beneficial owner. First, the OIV should be a resident of the jurisdiction where it is established and meet the other requirements for tax treaty benefits according to this tax treaty. If the above is not applicable, then the OIV should be stipulated in a specific provision of the relevant tax treaty as to be eligible for tax exemption, reduced tax under the applicable tax treaty. If neither of the above is applicable, the OIV should be viewed as the beneficial owner to the extent it does not disclose its investors. So what should this tax law amendment mean in practice? If the foreign fund is located in a tax treaty jurisdiction, it should be able to claim tax treaty benefits to the extent it is a tax resident of such jurisdiction and or otherwise eligible for tax treaty benefits under the treaty. In other words, it does not need to disclose its investors to claim tax treaty benefits. However, if the foreign fund is not eligible for tax treaty benefits, then the fund would need to disclose its investors. Otherwise, it would be viewed as the beneficial owner by default and would then be subject to tax under the Korean domestic tax law. Finally, on a separate matter, it should be noted that the MLI has been entered into force in Korea, and the PPT, or the principal purpose test, should apply to all foreign investors claiming tax treaty benefits. This tax law amendment would be important for foreign funds that invest into Korea, as historically there was a great deal of unclarity and disputes regarding when a fund can be viewed as the beneficial owner of Korean income, as opposed to the investors of the fund. This tax law amendment should further clarify this issue and providing certainty to foreign fund investors. The tax law amendments also make certain changes to the Korean VAT compliance obligation rules, some of which are substantial. A few of the major changes include the following: extension of time for issuing amended VAT invoice. Historically, a taxpayer could only issue an amended VAT invoice no later than the VAT return due date, which is 2 times a year. The tax law amendment now provides a grace period for up to 1 year after the VAT return due date. Extension of time to claim input VAT refund. Historically, if a VAT invoice was issued after the supply date, the previous law allowed late input VAT credits to the extent such VAT invoice was issued within 6 months from the VAT return due date. The tax law amendments extend the grace period for this to 1 year. New obligations imposed on foreign business owners providing electronic services under the digital VAT regime. The digital VAT regime is a simplified VAT compliance process applicable to foreign suppliers of electronic services such as apps, games, music, and so forth, without a business place in Korea. Effective July 1, 2022, the tax law amendments mandate that such suppliers keep transaction documents related to its e-services for up to 5 years after its VAT return due date, and also impose an obligation to submit those documents upon request by the Korean tax authorities. Next, I would like to discuss the new reporting requirements for our liaison office. Under the tax law, a liaison office in Korea may engage in non-income generating activities on behalf of a foreign company. Non-income generating activities include public relations, information gathering, research, and other similar activities of a preparatory or auxiliary nature. A liaison office technically should not create a permanent establishment for income tax purpose or a business place for VAT purpose. The tax law amendments stipulate that the liaison office shall now be required to submit certain information on the status of the business of the office annually. The stated purpose of this new reporting requirement is to prevent foreign companies from conducting business and income generating operations through their liaison office without registering the office as a permanent establishment. The related PD amendments, which will be discussed later, prescribe the details of the scope of information to be provided to the tax authority. The next tax law amendment I would like to discuss is the new limitation on deductions of NOLs. Historically, if a loss-incurring company were to acquire a profitable business or business line, there was no limitation on the offset of its NOLs against the income generated by the new business or business line. To combat this perceived unfairness, and as a new anti-avoidance measure, the tax law amendments now provide that in the case of a business transfer, the acquiring or transferee company may not offset its NOLs against the taxable income of the acquired or transferred business if generally 2 conditions are met. The 2 conditions are the transaction is between related parties and 70% or more of total assets and 90% or more of net assets are transferred. Finally, I would like to briefly discuss a notable amendment to the Korean CFC rules. This tax law amendment is more relevant to Korean companies with businesses overseas rather than to foreign companies with subsidiaries in Korea. But I wish to point this out as it is rather a significant change. The Korean CFC rules are intended to prevent tax avoidance or tax deferral in the case of outbound investments by Korean companies through the use of foreign subsidiaries located in tax haven or low tax jurisdictions. Very briefly, if a subsidiary in a tax haven were to earn income, then the Korean parent company could be required to recognize such income currently for Korean tax purpose, even if the subsidiary does not distribute any dividends up to the Korean parent. Historically, a tax haven or low tax jurisdiction for CFC purposes was defined as a jurisdiction in which the effective tax rate, or ETR, was 15% or less. This threshold has now been changed to 70% of the headline Korean corporate income tax rate, currently 25%. So the new threshold ETR is 17.5%. Now, I would like to turn over to my colleague, Steve Kim, who will discuss some of the significant PD amendments as well as revisions to the transfer pricing rules. Thank you, Steve.
Thanks, Tom. Before getting into my portion of today's webinar, I'd like to take this opportunity to express my gratitude to AMCHAM Korea for allowing us to present this topic today. And at the same time, I'd like to thank all participants here for joining today's event, despite your busy schedule. My name is Steve Kim, and I'm a tax partner of Lee & Co, specializing in international tax and transfer pricing. Tom just laid out Tax Law Amendment 2022, and now I'm going to shift the gear and talk about changes to Presidential Decree of Tax Law, in short PD, just recently enacted. Even though PD is not in the same status as the law itself, it's still binding authority and is generally regarded as close to the law. Today, I'll cover 4 major PD amendments that may be relevant for both foreign invested companies in Korea, as well as some Korean MNEs having business presence overseas. The first topic we'll have a look on this slide is withholding tax requirement on salary payment to foreign companies dispatching its employees to Korea. To give you a bit of a background, this particular provision was first created in 2017 to strengthen Korea's taxing right on foreign expats dispatched to Korea. And the 2022 PD amendment was made to provide more clarity as to who is subject to this withholding requirement rule, sort of a bright line rule, if you will. As you can see on this slide, there are 3 requirements for a company to be subject to this rule. The first requirement is the total annual salary payment to foreign company dispatching employees should exceed 2 billion Korean won. Second requirement is the Korean company that intakes seconded employees should be classified as a large corporation with sales at least 150 billion Korean won, or at least a total asset of 500 billion Korean won in the immediate preceding years. The third requirement is that the Korean company should engage in a particularly designated industry such as air operator, construction, professional scientific and technical service, shipbuilding, and finance. The 2022 PD amendment state that the total annual salary payment to the foreign company is deemed exceeding 2 billion Korean won when total contractual amount with dispatching company exceeds Korean won 2 billion, or the actual salary payment to dispatching company exceeds 2 billion Korean won in the immediate preceding years. This particular regulation goes into effect starting from the payment to be made in fiscal year beginning on or after April 1st, 2022. So let's move on to the second amendment to PD, which is related to the topic Tom already touched upon on page 8. This particular new provision under the PD of corporate tax law is intended to clarify the parameter of the non-sales functions and to enumerate what information should be submitted to the tax office. Definition of the non-sales function, which is preparatory and auxiliary in nature, is something related to liaison, market research, R&D, and information collection activities. The key information required to be submitted to the tax office as part of so-called liaison office status information our lease agreement, status of employees, status of the operating fund, information about the business of foreign company, etc. This is in line with Korean tax authorities' recent press release on February 22nd, which is just yesterday, that they cracked down on 13 companies in booming industry like semiconductor, shipping, and who try to illegally disguise themselves as liaison office when their substance should have been a permanent establishment. Implication here is that we should be careful and double check when we report the details around the liaison office, making sure the real conduct is aligned with what we're purportedly doing on paper. But at the same time, we do not want to unnecessarily increase the unintended tax exposure resulting from the reporting. The third PD amendment here on this slide, I would like to cover, has bearing on information that can be demanded by Korean tax authorities in order to facilitate exchange of information with other taxing authorities. Specifically, by virtue of this new PD, the Korean tax authority will be given a right to request the information about the beneficial owner of pass-through entities to taxpayers. The information may be requested in order of 1 and 2 and 3 here on the slide, which just basically means when the information number 1 is not available, number 2 can be demanded, and number 3 if number 2 is not available. In case of a partnership, a shareholding may not be an appropriate proxy to determine the beneficial owners. Information on key executive or de facto owner shall be demanded instead by the Korean taxing authorities. So we're on the last point on the PD amendment. This particular new provision under the PD of the law for coordination of international tax affairs is intended to alleviate compliance burden for Korean taxpayers incurring loss from direct invested overseas companies. There are 2 main requirements for a Korean company to be subject to this reporting requirement, as you see on the slide. And also there are a few exceptions to this reporting, depending on the sources of loss, which are listed on this slide as well. The requirements are the Korean company hold 10% or more of shareholding in foreign company, and loss incurred from the in-scope transaction exceeding 5 billion Korean won in a single fiscal year, or 10 billion Korean on a cumulative basis for 5 years, with an exception applied to loss incurred from the sources as listed on the slide. So those are the loss from the sales and purchase of inventories, depreciation and amortization expense, loss from disposal and valuation of publicly traded securities, loss from foreign currency revaluation on the monetary asset and liability. And lastly, this is a newly added the item, the Forex transactional loss, which is, as you know, it is the loss coming from different Forex rate applied between the time of the recognition and time of settlement. So now let's shift the gear and take a look at what updates have been made to transfer pricing. Thanks to lots of changes and development that have been or is being made by the OECD in recent years, there have been a quite significant update in Korean transfer rule as well. In a nutshell, there are 2 prongs in 2022 TP amendment in Korea. First one has to do with the TP guidance of COVID-19 pandemic, and the other one is, thank you. The other one is related to the financial TP guidance of the OECD. The first 2 points on this slide have a bearing on TP implication of COVID-19. So let's take a look at the first point here on this slide. Starting from the tax assessment in 2022 and onwards, loss-making companies could possibly be included in the comparable companies for benchmarking purpose when they are deemed comparable enough in light of function, risk, and asset profile of the tax party. And this is because excluding loss-making companies without a solid reason may simply bias the benchmarking result in the COVID era. One implication here is that this will highlight the importance of the industry analysis, delineation of intercompany transactions, and the company's specific reason as to why it was detrimentally hit by the COVID-19 in TP documentation. Because the level of impact of the COVID-19 may vary across the different industry, and even within the industry, the impact may vary depending on the company. The second point on this slide also related to the transfer pricing implication of COVID. Korean government made an exception to the Korean taxing authorities' right to make TP assessment when actually contributed cost is not aligned with the expected benefit of the participant under the CCA arrangement. Exception applies if any parties to the cost contribution arrangement cannot make contribution per their existing arrangement, and such non-compliance is deemed attributed to the force majeure condition. If these two requirements are satisfied, Korean tax authorities may accept properly revised allocation ratio reflecting such force majeure condition. Moving on to the third and fourth point under TP, which are related to financial transactions. Third point here on this slide covers intergroup loan pricing. This is a very, very common issue facing multinational corporations. And Korean government's 2022 amendment was made in an effort to update its outdated intercompany loan pricing regulation under its current TP rules. Before this amendment, there was no concrete loan pricing methodology that taxpayer could comply with. The only recourse, I guess, the taxpayer had before this amendment was to count on Korea's safe harbor rate for both inbound and outbound loan transactions. But the safe harbor rule per se is outdated as well because it does not reflect the low interest era we're living in and recent transition away from the LIBOR-based benchmarking rate. So what's the implication here? Now, with this new amendment kicking in, taxpayers in Korea have more legit options available for their intragroup loan pricing. There are two detailed methodologies laid out in the PD amendment. First one is to allow use of credit default swap spread as a proxy for risk premium, which is pretty akin to financial guarantee fee in concept. And second one is to allow the use of economic modeling based on the risk-free rate and risk premium. These methodologies in and of itself are not novel concept, but implication here is now there is a clear legal basis in Korea taxpayers can rely on, which will likely provide some tax certainty for taxpayers. Just for information, Lee & Co has recently published an article on this particular topic in Bloomberg Tax. So please do let us know if you're interested. We're more than happy to share the article with you. The fourth point on this slide has bearing on cash pooling arrangement. In anticipation of extended use of the cash pooling arrangement among multinational corporations, Korean government has adopted the cash pooling provision under its own TP regulation to solidify and broaden its taxing right. Basically, the new provision defines the concept of cash pooling. And let me give you the concise definition for those of you who are not familiar with this. Cash pooling is a liquidity-driven arrangement within a multinational corporation where the balance on the number of separate bank accounts of its group constituent in same or the different jurisdictions are brought together either physically or notionally in an effort to reduce external borrowing or earn even an enhanced return when there is a cash surplus. And on top of this definition, the new provisions stipulate how the remuneration for both cash per liter and cash per participant should be determined, which is quite complicated and technical to explain all in this presentation. So I'll give you a gist of it in layman's term. So we start with the cash per liter's remuneration as step one. In general, cash per liter's function is usually limited to the coordinating or agency function, and therefore its return should be highly limited as a service provider. However, under the situation where it exercises controlling functions, such as being responsible for funding any shortfall, or investing any surplus fund, or retaining financial capacity to assume the credit risk associated with the physical cash pooling arrangement, it may deserve part of the incremental group benefit created by the cash pooling. So once the cash pool leader's remuneration is determined, we go on to the cash pool's participant remuneration as step two. Under the physical cash pooling, as an intercompany loan relationship is created, an arm's length interest rate specific to the cash pooling arrangement should be calculated by taking into account group synergy and realistic options available to group participants, meaning it is expected that all cash pool participants will be better off than in the absence of the cash pool arrangement. Under the notional cash pooling arrangement, on the other hand, since there's no intercompany loan transaction among participants, incremental group benefits should be allocated based on the expected benefit of each participant in the form of interest expense saved or interest revenue incrementally earned. Like I said, the concept is pretty complicated, and due to the time constraint we have, I'll just scratch the surface on this cash pooling. But if you believe your business could be impacted by the new update, please feel free to reach out to us to get more detailed information. The last piece under the 2022 TP amendment is related to the Korean government's effort to induce taxpayers' early compliance with BEPS Action 13 documentation. Currently, taxpayers will be imposed a non-compliance penalty of 30 million Korean won per report, so long as either these reports are not submitted by the deadline, which is within 12 months from the end of each fiscal year, or timely submitted report include intentional force or misleading information. However, after the amendment, depending on the timing of submission or corrections after the deadline, taxpayers' burden of penalty could be significantly reduced in an effort to prompt taxpayers to comply with the requirement even after the deadline. The penalty reduction scheme is set with the declining scale as shown in the table here on this slide. So basically, the longer the time lapse from the deadline, the lower the deduction rate taxpayer will be eligible for. So I guess this is the end of my presentation, and I'll pass back to Shim to kick off the second session of our webinar.
So Steve and Tom, thanks very much for the presentation. It would appear that Korean government, I should say, is still on a path to harmonizing the rules that we're seeing developed across the jurisdictions around the world, initiated by OECD. I guess that's a good trend, because I think for MNCs, the challenge is always trying to follow one set of rules in one jurisdiction and another set of rules in another jurisdiction. And obviously there should be some coordination and harmonization of these rules so that taxpayers can comply more effectively. I should add that at the beginning of this introduction, I think everyone has a spot in their computer and below left, perhaps it's bottom right or bottom left. I'm not sure, but that will allow you to type in some questions that you may have for either Tom or to Steve, and of course, or to the next speaker, who I'm very pleased to present. We have Jung-hong Kim, who is a recent joiner to Lee & Co. He is currently serving as our international tax practice co-head, and he is a tax partner in our tax and customs group. Mr. Kim joins us from the government, so I think it's of interest to many of you in the audience, because of course we're always interested in the latest thinking of the Korean government insofar as tax and tax policy matters are concerned. Just briefly, Mr. Kim, prior to joining Lee & Co, served for several decades, to be sure, in his capacity as an official of Minister of Finance and Economy. He also spent some time having seconded to the Supreme Court as a tax research specialist, and also to the OECD Korea Tax Center, where he served as the head of the OECD Korea. And the topics that he's going to talk about is, I think, probably one of the most important tax developments we're seeing, frankly, in Korea, even in midst of what's going on around the world. I know that some of you, like myself, watched very carefully last night the developments that are going on in Russia and Ukraine, But at the same time, the OECD has its job. I don't think that any of what's going on around the world is going to undermine or even retard the progress that OECD has made over the past couple of years, and especially the latest portion of these rules, as many of you know, deal with so-called Pillar 1 and Pillar 2, which has its genesis in BEPS. So without further ado, let me introduce my colleague, Mr. Kim, and he will talk about the OECD developments on global tax reform and its potential impact in Korea. Thank you.
Thank you, Jay, for your kind introduction, and good morning, everyone. First, I appreciate this opportunity to share with AMCHAM Tax Committee members the recent developments on global corporate tax reform. I was personally involved, as Jay mentioned, in the initial stage of discussions of digital tax task force of the OECD in 2018 as head of International Tax Division of the Ministry of Finance. We used to call it at that time digital tax, but this is now a misnomer since the new tax reform is not targeted at purely global IT giants such as GAFA. First, I need to mention a little about the background. BEPS, Base Erosion and Profit Shifting project of the OECD started in 2013 in the aftermath of the global financial crisis in order to combat international tax avoidance of multinationals. Of the 15 BEPS project actions, Action 1, taxation on digital economy, has been the last remaining item to implement. It took more than 4 years for the international community called Inclusive Framework to reach agreement on the two-pillar solution, which was welcomed by the G20 leaders at the end of October 2021. It would be fair to say that the negotiations can be treated as the conclusion of Uruguay round in international taxation. Now we are on Pillar 1. This is basically about reallocation of taxing rights among markets on the super or excess profits of the world's largest multinationals. The in-scope M&E turnover threshold is over 20 billion euros, and 25% of the M&E's residual profit, which is the profit amount of 10%, will be allocated to each market country, regardless of the existence of a physical presence. That is to say, permanent establishment or subsidiaries. The extractive industry and the regulated financial services to be specified in the future are excluded. Technically, the amount of profit to be reallocated is called Amount A. For the nexus of the tax, market country threshold revenue will be over 1 million euros for in-scope M&Es. For sourcing of the revenue will be sourced to the end market where goods or services are used or consumed. Tax-based determination will be based on multinationals' consolidated financial accounting income with some adjustments. And to enhance tax certainty, disputes will be resolved in a mandatory and binding manner. There will be a simplified rule for baseline marketing and distribution activities for market jurisdictions. And the market allocated profit by this method is called Amount B. And unilateral measures such as digital services taxes will be abstained and removed once Pillar 1 is in effect. Now we are on Pillar 2. Pillar 2 is about introducing the global minimum tax in order to neutralize tax competition practices of low tax jurisdictions and multinationals. The tax will apply to M&Es with an annual revenue of over 750 million euros, which is the same with BEPS Section 13 CBCR requirement. In this diagram on the right, operating subsidiary in B shifts profits to a low tax jurisdiction down under. With income inclusion rule, the low tax income will be taxed at the minimum rate of 15% in country A, where the ultimate parent entity is a resident, which is called a top-up tax. When the income inclusion is not applied at the ultimate parent entity level because country A is also a low tax jurisdiction, then under tax payment rule kicks in which case country B would deny deduction or levy a top-up tax on operating subsidiary. Both income inclusion rule and UTPR are not mandatory for countries, but once chosen, compliance with the rules are required. This is called common approach. And the effective tax rate is to be calculated on a jurisdiction basis, which means there are multiple subsidiaries. If there are multiple subsidiaries in a country, the sum of taxes will be divided by the sum of tax bases. There are carve-outs for substance related to tangible assets and payrolls. International shipping income will be excluded as well. And another prong of Pillar 2 is subject to tax rule, which allows the source country to impose limited taxation on outbound payments, such as interest and royalties, if they are taxed below 9% in the payee's country. Now, let me talk about global and local impacts. Globally, as mentioned earlier, Pillar 1 is basically about reallocation of taxing rights. And Pillar 2, on the other hand, will lead to additional global tax revenue. Locally for Korea, Pillar 1 will likely affect Samsung and SK Hynix, whose excess profits will be reallocated to market countries. And inbound foreign M&Es meeting the threshold may be subject to amount A tax in Korea. For Pillar 2, most local subsidiaries of foreign M&Es will not be subject to top-up tax in parent jurisdictions because Korean ETR will normally be over 15%. You may remember that in December 2018, Korea abolished preferential tax regime for domestic companies invested with foreign capital in compliance with the EU Code of Conduct Review of Business Taxation. Then does the two-pillar system solution mean the end of international tax avoidance and the tax competition as we know? We have to look at how the details will be crafted and implemented. This will be covered in the next slide. Both pillars need to be leveraged in legal instruments which are supposed to take effect in 2023. For each pillar, a very ambitious timeline is scheduled for drafting, signing, and implementing the legal instruments such as model rules and multilateral conventions. For Pillar 2, model rules for domestic legislation was published in December 2021 for each jurisdiction to reflect in domestic law. For Pillar 2, drafting of both multilateral convention and model rules is in progress, and we expect the draft to be published in this spring. Then what is the situation in the US, whose implementation of the two pillars is key to success of the global tax reform? Frankly, the future is not so bright. For Pillar 2, the US guilty tax reform is needed, but as you know, the Build Back Better Act is almost killed in the Senate. For Pillar 1, gaining 2/3 of the Senate support for the multilateral convention will be a huge challenge for the Biden administration. Then what is going on in Korea? Korea has begun its domestic tax legislation project at the end of this January. And Lee & Co, in consortium with Samil PwC, has been retained for Pillar 1 tax legislation project by the Ministry of Finance, which we are supposed to finalize by May 2022. In this regard, we hope we could have a chance to discuss further the Pillar 1 tax implications for inbound multinationals in our next engagement with AMCHAM Tax Committee members. Thank you for your attention.
Right, great. I think that was very useful to understand the current status of where we are on Pillar 1 and Pillar 2. I think of interest to AmCham audience is that as Mr. Kim pointed out, without the cooperation and participation of the US, I think both Pillar 1 and 2 is going to be very difficult to implement and adopt around the world. As I mentioned mentioned earlier about harmony and harmonization. So I guess we have, we're almost near our session, and I'm getting a couple of questions. So maybe I'll begin with the first question that I received. There's still time. If you want to type in a question or two, please let us know. I would like to end this a little bit early. We still have time. So anyway, the first question that we received is, COVID pandemic is still raging around the world, including Korea. Do you anticipate any further tax reliefs being provided by the government? And I think maybe I'll ask Steve to answer this, because of course the TP rules last year provided some flexibility in terms of how we measure profitability based on the impact that COVID may have had on Korean companies from a comparability standpoint. So perhaps he can chime in on this point. Steve?
Yep. Yeah, I can maybe shed light on this questions. Last year, as many people already know, the NTS provided various administrative support to reduce the burden on companies affected by the COVID-19, such as postponing scheduled tax audit, as well as the stalling tax audit that have already started, with an exception where the expiry of statutory limitation period is imminent. So also this year around, NTS has offered an extension for the deadline for corporate tax payment and the VAT payment by 3 months and 2 months, respectively, for small and medium enterprise affected by the COVID-19. The caveat here is that this is the payment due date extension, but we need to file tax return by the original deadline. There are certain requirements that must be satisfied in order to benefit from these extensions. Qualifying taxpayers should apply for extension by email, in person, at their local tax office or online. So as for the tax audit, even though the NTS, we heard NTS collected much more than their target revenue last year, we're kind of witnessing that they're resuming their tax audit very aggressively this year and challenge loss-making companies, especially cases where their loss-making position is not underpinned by the sound and coherent story and evidence. As I laid out earlier in this webinar, if you believe your company has some cross-border related party transaction subject to transfer pricing regulation and incurred related relatively low profitability or even a loss-making position in recent years, you may want to fully leverage off of the new PD amendment that I introduced during the webinar that allows loss-making companies, loss-making comparables in their benchmarking for TP analysis purposes. But careful and detailed analysis as to how your company is detrimentally affected by COVID-19 should accompany in order to convince NTS in case of audit.
Okay, that's great. That's very helpful. I have one more question. Oh, this is a very interesting one. I'm going to direct this to Mr. Kim. So a lot of us know about the developments around OECD Pillar 1 and 2, and of course, Mr. Kim covered the Korean aspects of that during this presentation. The question is, when do you think the companies in Korea, whether that's domestic or foreign as the case may be, of course, we all know that only very, very large companies are impacted by it, right? There is a minimum threshold, but to the extent that it does, when will these companies feel the full effect of either OECD Pillar 1 or 2? I guess, is it going to be in the next year or two, or is it going to be several years from now? I think that's a very important question. So let me ask Mr. Kim to address that.
Okay, I find the question very great and hard to answer. As I mentioned, without the US implementation of Pillar 1 and 2, the whole digital tax project is meaningless, which means all depends on US implementation. In reality, however, the situation in the US is very fluid. So to the question, I would rather say in a skeptical manner that 2023 implementation will be extremely difficult. But companies should prepare for implementation at the global and local level as the domestic tax legislation develops in Korea and elsewhere in the world. So let me put it this way. You should prepare for the implementation for the time being, but I would say that realistically, the digital tax will take effect from 2024 at the earliest. And this is off the record, sorry. Because I'm working with the government and as a lawyer retained, we should do our best in good faith to keep the timeline. Thank you very much.
All right, well, that's, what can I say? It's what an ex-government official would say, right? Well, thanks very much for staying with us for the last 55 minutes. We have a couple of minutes, and I'll just, if you will, I'd like to just let you know in advance that this year, I think everyone anticipates COVID either going away or governments being able to, and AMCHAM as well, being able to handle COVID situations more reasonably. And on behalf of AMCHAM, I know that there's going to be more presentations and seminars this year, much more active than last year. And I understand that some of these presentations are going to be held live so that we can go back to being normal again. And one of the things that the Taxation Committee is planning is to do a joint session, because some of you say, oh, tax is so dry, and I don't really have the patience to listen to all the nitty-gritty details of tax rules. Well, of course, some of you do appreciate these kind of seminars, and we will continue. And on the other hand, for those who do think that we should have something much more, let's say, relevant, we are planning to have joint sessions with other committees, right? With real estate committee, with private equity committees and the like. That's something that we're going to work on this year. So I hope all of you, when you have the opportunity and you get these flyers from AMCHAM, you take a look and see if it's interesting for you. So as a final comment, thanks very much to my colleagues, to my immediate left, Tom Kwon, and to Steve Kim, and to Mr. Jung Kim. And we hope to see you soon, and have a great day. Thank you.